What if your investment portfolio sent you a paycheck every single month without you selling a single share and without you doing a single thing? That's not a fantasy. That's a dividend investing strategy. And today, I'm going to show you exactly how it works, how much you need to make it happen, and the fastest way to build toward it starting from wherever you are right now. Let's start with the basics, because this is one of those concepts that sounds complicated but is actually beautifully simple. When you buy shares in a company or a dividend-paying fund, that company pays you a portion of its profits on a regular basis. Quarterly, sometimes monthly, just for owning the shares. You don't have to do anything. You don't have to sell anything. You just hold the shares, and the money shows up. That payment is called a dividend, and it is one of the most powerful passive income mechanisms available to everyday investors. Now let me show you the math that makes this genuinely exciting. The average dividend yield of the S&P 500 is about 1.5% to 2% per year. But there are funds and stocks specifically designed to pay higher dividends, 3%, 4%, even 5% annually. Let's use a conservative 4% dividend yield. If you have $100,000 invested in a 4% dividend yield portfolio, you receive $4,000 per year in dividends, $333 a month, without selling a single share. $250,000 invested, $10,000 a year, $833 a month, $500,000 invested, $20,000 a year, $1,667 a month, $1,000 invested, $40,000 a year, $3,233 a month. Now here's what makes this extraordinary. While you're receiving those dividends, the underlying portfolio is also growing. So you're getting paid every month, and your net worth is increasing. That is the dividend investor's dream. And it is absolutely achievable. Now, let's talk about dividend reinvestment, because this is where things get really interesting. If you're not yet at the stage where you need the dividend income to live on, you reinvest those dividends back into the fund. This is called DRIP, Dividend Reinvestment Plan. And most brokerages do this automatically. Here's what it does to your timeline. Someone investing $500 a month into a dividend fund with a 4% yield, reinvesting all dividends at 8% total annual return over 20 years, ends up with significantly more than someone in a non-dividend fund with the same contributions. Because the dividends are buying more shares. Those shares pay more dividends. Those dividends buy more shares. It's compounding, but with a cash payment engine running inside it. Now, let me show you some actual options so this doesn't stay theoretical. Option 1. VYM, Vanguard High Dividend Yield ETF. Holds around 450 dividend-paying companies. Expense ratio of 0.06%. Current yield approximately 2.8%. Diversified. Low cost. Reliable. Option 2. SCHD, Schwab U.S. Dividend Equity ETF. One of the most popular dividend ETFs ever created. Focuses on quality dividend-paying companies. Current yield approximately 3.5%. Exceptional 10-year track record. Widely considered the gold standard for dividend ETF investing. Option 3. JEPI, JP Morgan Equity Premium Income ETF. Higher yield, approximately 7 to 9%. Pays monthly dividends. Uses an option strategy to generate income. Higher yield comes with lower growth potential. Best for someone who wants income now rather than maximum long-term growth. Option 4. Individual dividend stocks. Companies like Johnson & Johnson, Procter & Gamble, Coca-Cola, Realty Income. These are called Dividend Aristocrats, companies that have raised their dividend every single year for 25 years or more. Realty Income alone pays dividends monthly. Now here's the strategy question you need to answer for yourself. Are you in the accumulation phase, building the portfolio, or the income phase, living off the dividends? If you're in your 30s or 40s, you're almost certainly in accumulation, which means drip everything. Reinvest every dividend. Let the compounding engine run. If you're approaching retirement or building toward financial independence, start shifting toward dividend income funds like SCHD or JEPI, and begin building the monthly income stream you'll eventually live on. Here's your action plan. 1. Determine which phase you're in: accumulation or income. 2. Choose your dividend vehicle. VYM for growth with dividends. SCHD for the best balanced approach. JEPI for maximum current income. Dividend Aristocrats for individual stock exposure. 3. Turn on DRIP automatically. Every brokerage offers this for free. Set it up once and let it run. 4. Set a dividend income target. How much monthly income do you want dividends to cover? $1,000, $2,000, $3,000? Work backward to find your portfolio target. At 4% yield, $1,000 a month requires $300,000 invested. 5. Start building toward it today. Every dollar invested now is a future monthly dividend payment. Every share you own is a vote for your future passive income. The portfolio that pays you every month is built one contribution at a time. Start now. Subscribe for the next breakdown. New video every week.